Welcome to Lesson 15, Chart Basics Lesson 1. Starting today, we learn how to read charts. First up, Candlestick Chart Fundamentals. What we'll cover: 1. Candle anatomy, open, close, high, low. 2. The psychology of bullish versus bearish candles. 3. Three classic candle patterns. 4. Why context changes every judgment. Without candles, a chart just looks like a vibrating line. Once you learn them, you start seeing the tug of war between buyers and sellers. A headline that Bitcoin swung from 65,000 to 70,000 in a day matters less than who was pushing and who was holding inside that range. The same way S&P 500 sessions tell a story beyond the closing print. We'll work off the Bitcoin daily chart on your screen. Drop a comment and tell me, are candles brand new to you, or are you already reading them? Every candle is built from exactly 4 prices: open, start, close, end, high, peak, and low bottom. Those 4 alone make a complete candle. The thick part between open and close is the body. The thin lines above and below are the wicks, or shadows. The body is the actual result. Who won? The wick is the trace of a move that was attempted and then rejected. Example: Bitcoin opens at 65,000, rallies to 72,000, and closes at 67,000. That whole day compresses into one candle. The upper wick is evidence that price was pushed to 72,000 and then forced back. A long wick means that direction was tried and met resistance. A long upper wick reads as buyers try to go higher, but sellers were stronger. A long lower wick reads as price dropped, then buyers scooped it back up. On the Bitcoin daily chart in front of you, find one candle with an especially long upper wick. Imagine the psychology that wick is describing. If the close is above the open, it's a bullish candle. If the close is below the open, it's bearish. Think of a bullish candle as buyers beat sellers that session, and a bearish candle as sellers won the day. Watch the colors. Charts paint bullish candles green, red, or white depending on the platform, so never memorize by color. Remember only open below and close above, bullish, or the reverse, bearish. Body length decides how meaningful the win was. A long body means one side dominated, like the difference between a month your paycheck jumped 1,000 versus a month it rose by 10. A very short body means a tight tug of war. When open and close are nearly identical, buyers and sellers were roughly balanced. On the chart, find a big bullish candle, long body, and a big bearish candle, long body. Those are often days when news or psychology, a Fed decision, an earnings dump, a risk-on rally tilted hard one way. An engulfing pattern is when a new, larger candle completely swallows the previous one. Historically, it often shows up near potential trend turns. Concrete example: Bitcoin is falling. Yesterday printed a Paris candles earning roughly $66,000, $68,000. Today opens at 65,000, rallies to 70,000, and closes at 69,000. The new bullish candle fully covers the prior bearish one. That's a bullish engulfing. It signals sellers are weakening and buyers are starting to take control. A doji is a candle where open and close are nearly the same, so the body is missing or tiny. In plain English, it's a day of indecision. The shape looks like a plus sign, plus symbol, or an inverted T. When a doji appears after a strong rally or sell-off, it can be a caution that momentum is fading and direction may change. Alone, it's weak. Next to support/resistance or with volume confirmation, confidence rises. the same idea traders use on the S&P 500 or daily charts. A hammer has a small body near the top and a long lower wick hanging down, shaped like a hammer, which is how it got the name. Concrete example, Bitcoin is falling, closes at 65,000 after trading as low as 59,000, with the session low near below 62,000 on the body. That long lower wick means sellers shove price down toward the 59,000. Then buyers fought it back. At a downtrend low, this pattern has historically often been followed by reversals. An inverted hammer is the mirror image, a long upper wick with the body down near the bottom. In an uptrend, it can signal buyers pushed higher, but got capped by selling pressure. The core idea is simple. Wick equals a direction that was attempted and rejected. Understand that psychology and other candle patterns become intuitive. You won't need to memorize shapes alone. A hammer by itself is a weak signal. Check whether it's near support, whether volume expanded, and what the broader trend is, including whether risk assets like the ASAG are confirming the same story. Here's the biggest trap with candle patterns. The same hammer in the middle of an uptrend means something completely different. Location and context are everything. Check context 3 ways. 1. What's the overall trend? Up, down, or sideways? 2. Are you near support or resistance? A meaningful price level? 3. Is volume confirming? Did volume rise with the pattern? Example. 3 months of decline, near support, plus a hammer, plus a volume spike, equals much higher confidence. By contrast, a random doji in the middle of nowhere may just mean one quiet, balanced day, like a coffee shop that stayed busy after a 3 a cup with no price fight. Trading on one pattern alone makes losses more likely. Always ask first, in what context did this pattern appear? Pick one pattern on the chart and ask yourself, 1. What are the prior 5 to 10 candles saying? Up or down? 2. Is this price level meaningful? 3. Did volume spike with this candle? If all 3 answers are yes, confidence jumps a lot. Lesson 15 wrap-up. First, a candle compresses open, close, high, and low into a body in wicks. The body is the result, for 1. The wick is the trace of rejection. Second, a bullish candle is a buyer's win. A bearish candle is a seller's win. Don't sort by color. Remember only whether close sits above or below the open. Third, patterns like engulfing, doji, and hammer look powerful but are weak alone. You need trend, support/resistance, and volume together before you trust them. On Bitcoin, the S&P 500 or the NAG alike. Next lesson, we cover time frames. The same Bitcoin looks like a scalper's signal on a 1-minute chart and a long-term trend on a monthly chart. Same data, totally different story depending on the angle. You'll feel that shift. If this helped, hit subscribe and like. Questions or a pattern you read differently? Leave a comment. Finally, this lesson is for education only. Every trading decision and its outcomes are your own responsibility.